Michael D'Alessandro from Bowling Green State University. I think the most exciting aspect of the challenge would be that we almost got to be a part of a team and we got to work almost like a regular analyst. And not only that, but we also got to interact with the management team from Herman Miller, as well as just diving into all the data and analysis was really exciting for our team. Definitely harder than we expected. It definitely took a lot more work, a lot more time than originally thought it would. So I would definitely say it was a lot harder. I think this will shape my future career goals a lot because I had a lot of fun doing this and I thought it was very interesting. And I know I have a background in finance. I'm a finance major and wasn't really sure what I wanted to use that finance for. And I definitely think that research analysis, especially equity research, would be something I'm interested in. From what I know, yes. Obviously, I haven't been in the real-world experience with equity research, but I definitely think it was. Obviously, we got to, like I said before, we got to meet, talk to the management team. We were allowed to go to the Zealand headquarters, and everything seemed as real as it could be.
Okay. Good morning. Thank you all for being here today. My name is Greg Glenn.
Leah Johnson.
Benton Collins.
Michael D'Alessandro.
And we're here from Bowling Green State University to present our evaluation of Herman Miller today. After extensive research and analysis, we have decided to give a hold recommendation on Herman Miller. We chose this recommendation because our price target of $23.18 did not exceed our 10% threshold above or below the current price to constitute a firm buy or sell rating. This will be the basis of our presentation moving forward. Moving on with the presentation, we'll discuss the company overview, key avenues of growth, as well as the risks evaluation, before moving on to our methodology behind our evaluation. In regards to the company, Herman Miller is a high-quality manufacturer of office furniture, which it ships worldwide. The company is known for its strong brand image, as well as its high-quality, innovative products. Herman Miller is a small-cap company with $1.6 billion in sales in 2011. These sales the majority of these sales are generated through its North American Furniture Solutions segment, which is 72% of sales, and its non-North American Furniture Solutions segment, which is 20% of sales. Then they sell retail in their small segment, specialty and consumer, which is about 8% of sales. These sales, along with their strong brand image, allow them to remain a key player in their industry. Looking at their industry, through an analysis based on Porter's 5 Forces model, we see buyer power was given a moderate rating. This rating is due to the large number of individual consumers within the industry, which allow manufacturers to set price levels. And also because these buyers do have some power as they can purchase through smaller retailers. Next is supply power. This is given a strong rating. This is due to the need for manufacturers to receive their supplies in a timely manner to allow for production, and also because of commodity market pricing. Next is industry rivalry. This is given a strong rating. This is because of the large number of manufacturers within the industry, both big and small. Next, threat of substitutes. This is given a moderate rating because of the lack of products that are available outside of the industry to replace these products, and also because of the large variety within the industry of different products. And last is barriers to entry. This is given a moderate rating because of the high cost associated with creating a customizable product line, as well as the economies of scale which allow larger manufacturers to set their price levels lower when bidding on contracts. Now I'll hand the mic over to Leah to talk about the avenues of growth.
There are 3 key growth drivers in our valuation. The first is the short-term growth in Herman Miller sales that we predict due to strong industry indicators. Herman Miller's revenues mimic corporate profit trends with a 6 to 18-month lag. Recently, corporate profits have been slightly increasing, which should be reflected in Herman Miller sales over the next year. Another positive indicator is that the U.S. office sector in 2011 recorded the strongest level of demand for office space since 2007. This strong demand and recent drop in office vacancy rates may also be signals that there will be increased demand for office furniture in the near future. Additionally, the Architectural Billings Index shows an increase in the non-residential construction billings at the end of 2011, which may also be an indicator for increased demand for contractual office furniture. All three indicators point towards short-term sales growth for Herman Miller. It is reflected in our valuation as we assume 7% and 6% overall sales growth in fiscal 2012 and 2013 respectively. For sustained long-term sales growth, Herman Miller must continue to produce innovative new products and expand into new markets. In 2011, 22% of Herman Miller's revenues were from the sales of products that were introduced in the last 4 years, showing the importance of new product development. Herman Miller recognizes this need and actually spent more on R&D as a percent of sales than close competitors. Herman Miller has also been able to expand their product offerings through the use of strategic acquisitions, such as the acquisition of Nemshoff in 2009, expanding Herman Miller into healthcare offerings, and more recently, the planned acquisition of Posh Office Systems, which will give Herman Miller access to the emerging markets of Asia. Herman Miller and this expansion into international is important because the non-North American segment is actually the fastest growing segment of the company, with 20% sales growth from the end of 2010 to the end of 2011. Finally, Herman Miller is looking to increase earnings through the continued implementation of cost-cutting initiatives. Herman Miller has always been a leader in lean strategies, and management believes that there will be $105 million in annual savings over fiscal 2012 due to cost-cutting initiatives. Cost of sales as a percent of sales has actually been decreasing for the past 3 years, and this is a trend Herman Miller looks to continue into the future. And now Ben will discuss the risks to our valuation.
Drivers and cost-cutting initiatives in place, Herman Miller faces many difficult risks it will need to manage in order to continue to deliver future sales growth and sustain profitability. Some of these risks include an economic downturn, competitive markets, foreign risks, material pricing, and government spending. An economic downturn would have an adverse effect in the amount of future sales that Herman Miller will have in the North American industry and cause an obvious downturn in the amount of spending in the furniture industry. Another risk is the highly competitive market that is present in the furniture manufacturing industry. Because of this, the market is so segmented that new and innovative products are needed to permit Herman Miller to outperform the standard furniture maker. However, these new products require a high amount of R&D spending and do not guarantee future sales or a profit. With the ongoing crisis in the European Union and the sluggish economy here in the United States, Herman Miller faces a tough economic environment for future sales growth in their largest market. They also face the risk of foreign exchange rate changes and the high volatility that has been present since the recent financial crisis. Along with the highly volatile currency markets, they also face the highly volatile commodity markets that drive raw material costs and could cause pressure on variable prices if costs were to rise dramatically. A final risk is the amount of government spending. With the recent 14% of sales in 2011, these sales could fall as governments cut back on their spending and pressure is felt across all levels of the government. Although all these risks are real and present, Herman Miller possesses the means to mitigate these risks through actions they can take, such as defending their strong brand image, applying appropriate currency hedging, and diversifying the revenue base. With one of the strongest brand images in the industry, Herman Miller is recognized as one of the premier furniture companies in the United States. This helps create a high-end persona and gives them a better purchasing power advantage over their smaller rivals. The company has also implemented a forward currency hedging program that allows them to hedge both net asset and net liability exposure in the foreign markets where they perform their lines of business. Finally, in looking at the chart, Herman Miller has diversified the revenue base dramatically since 2001. This is due to an increase in the amount of sales in the healthcare and education portion of the business and a decrease in the amount of sales to the U.S. government. Now that we have compared and contrasted the growth drivers and risk, I will hand the mic off to Mike to discuss our evaluation of Herman Miller stock.
Through the methods we used to value Herman Miller stock, we arrived at a target price of $23.18. The two methods we employed were discounted free cash flow to equity method and the comparable company multiple method. Required return on equity of 12.56%, which is calculated using long-term geometric mean returns of intermediate-term government bonds, small-cap stocks, and a beta of 1.1. To calculate the comparable company multiple intrinsic value, we used average normalized price to earnings, price to sales, price to cash flow, and per share data of Herman Miller and its three competitors, H&N Corporation, Knoll, and Steelcase. We used these competitors because they were all in the business industry, all sold similar products, and all were close to market capitalization as Herman Miller. We also used industry average to get a weighted average multiple, which we then multiplied by our 2012 forecasted per share data of Herman Miller to get a price range of $20.19 to $27.12 with an intrinsic value of $21.70. Our final target price uses a 70% weight on a discounted cash flow method and a 30% weight on a multiples method. We use these weights because the discounted cash flow was more consistent while the multiples was more skewed to high volatility in per share data and multiples of Herman Miller and its competitors. Our final target price is $23.18 with a hold recommendation. Are there any questions?
I'll start out. If the stock is right now a hold recommendation, up 20% on the year, it's had a great run. At what level is the valuation going to justify a sell here?
I think it would justify the sell. Obviously, if it would be lower than the current stock price, which it has actually gone down since we actually done this. We mostly did our valuation based on what we thought in the future. We didn't really base it on their price that was up 20% this year. We based it on what we thought of the industry and what we thought of the assets that the company has and what we thought that they would be in the future. So I think if it was, we were conservative also in our valuation, as we in a number of different ways. So I mean, it could go either way, but I think if it goes down just a little more, it could be obviously a sell.
Can you comment on how much exposure they currently have to Europe and international? I think you said 20% roughly of other business.
Yeah, they have 20% of their sales in the non-North American. Their biggest market outside the United States is Great Britain, which they have a large manufacturing there and also in China. But although they have it's not constituted as much as you saw the 72% to North American, it is a segment. It is growing as fast, 20%, a lot faster than what the North American part is. But they do hedge the risk, as I said, through their hedging program. Those are usually in 90-day durations of forward contracts. So they try to hedge it and lock in their prices and costs to offset the volatility that has been onset through the recent crisis and volatility. But they are looking to expand into Asia with their acquisition of Posh. That's where they see their next key growth driver is in Asia.
In your discounted cash flow analysis, I assume you're using the 7% sales and 6% sales projections. What economic assumptions are that? Are you going by what the company is assuming, or if there's a change in economic outlook, are these going to drastically change?
Well, there's already been reported for quarter 1 and quarter 2 of fiscal 2012 because they are May fiscal year end. And so we basically used those 2 quarters and projected out a similar trend for the next 2 to get our 7% overall sales growth for fiscal 2012. And then for 2013, we assumed that we were actually rather conservative in our assumptions going forward, as we looked at the industry drivers and saw that they are increasing, and with the turnaround in the economy, there should be increases in sales back to pre-crisis levels. And overall, in our valuation, our growth moving forward, we were very conservative, and the sales levels never actually reached in our valuation for the next 5 years back to pre-crisis levels. So our sales are definitely very conservative and could definitely move up, especially if this acquisition with Posh moving forward really does give them access to the Asian markets. Posh is actually only $50 million in sales in 2010, so that alone will not necessarily boost the bottom line, but it's more of what Posh gives them in the Asian markets.
How about funding? Are they able to fund their business? Their cash flow is positive?
Their cash flows are currently positive. Their revenue, they have many different ways of gaining revenue throughout their industry, as well as they use different independent contractors to to sell their product, as well as they own subsidiaries to sell their product, which brings in multiple different cash flows. And they also sell the products retail, as well as they have 14% of their sales go to the government through direct sales, which brings in a significant cash flow. And then they also have new e-commerce business, which is projected to bring in even more revenue.
Along with that, there is the concern though with the European crisis. If Greece were to fall and cause a major hiccup in the credit markets, there is the risk of a further freezing of the credit markets that could deter them from issuing new debt or equity capital, and could cause some constraints in their cash flows in the future if it were to repeat a 2008-like crisis, which could cause some concern in the future as just a way of forwarding that to keep that in the evaluation.
On longer term, more and more people are working at home in their pajamas and telecommuting. And office space may be consolidating. Longer term, is that by changing markets, or looking to address the home market as well as the office market?
Actually, no, they have primary markets, adjacent markets, and new markets. And the new markets involve healthcare as well as residential. So they are trying to are not currently in that market that much, so they're actually trying to get into that market because they know that will help them in their future growth.
As well, their smaller segment, the specialty consumer, is actually a retail segment directed towards selling to these types of individuals, as well as a new e-commerce website, which helps them to sell specifically to individuals. And as he touched on, that in the new markets, they are focusing on other markets as well, the healthcare industry, which, with their acquisition of Memshaw, they were able to become the market leader within that industry.
To add to that, they're also going to start, or they're going to try to start a lower cost product for the residential unit.
The percentage of sales to government, to U.S. government, and if they have exposure in Britain, how much exposure do they have to government spending in Europe as well? And what kind of margins would they get in that business relative to, say, direct sales to something that would be that you just described in regard to something that they're doing more on a retail basis? Any ideas on that?
Well, the government is a set contract, so I would imagine that's probably, I for sure know, but I imagine that would be a smaller margin because that's negotiated already. As direct sales, wasn't they hiked the price up for, was it direct sales or?
They actually have in their sales scheme, their prices are set at a very high rate, and then they discount that back almost 50% for most sales. But that gives them room to raise prices to make sure they do have a margin when they are selling their product. As for overseas market, I know they have limited exposure to Spain and the other countries, because in Europe they're almost exclusively in Great Britain.
Yeah, as for you said you were asking about UK government spending?
I'm asking about just their exposure to European government spending and the issues in Europe today.
Yeah.
If a lot of their business is domestic government, U.S. government sales, governments have always been great customers for these organizations. How much risk is there? And pricing too, because again, pricing is always a challenge. And when you have big customers, you tend to have better pricing. So that's really the question.
I think with the recent austerity that all the governments are trying to implement and the public outlash that has been going on towards the governments, I believe they will become a smaller segment of their sales and probably see a slight decrease in the amount. And I think the governments will be tougher on their margins, as you said, and the prices are going to be a lot more competitive. And with the international exposure and globalization of the markets, you're going to get a lot of more competitors from Asia and like South American markets that will come in and compete. With the lower currencies, the prices alone will be lower to compete against with the British pound and the US dollar. So that alone will constitute a lower or a higher competitive market and lower profitability probably going forward in the European government spending.
Good.